Hi there. My name is Trevor Crow, and with the law firm of Doida Crow Legal. And today we're here to talk about M&A SALT issues. So SALT stands for state and local taxes. And so we're going to provide an overview of state and local taxes, really the non-income taxes that can impact an M&A transaction. And so obviously there's state and local taxes at the state and local income taxes, but in general, we're going to be focusing on the other issues. Um, just a quick overview of the firm. Doida Crow Legal, we're a business transactional firm, and we help entrepreneurs grow, finance, and buy and sell businesses. And really, we have a big focus in M&A, lower middle market M&A deals, kind of in the $1 to $50 million range. We represent a lot of buyers and sellers in transactions, and yeah, so we're located in Denver, but we have done deals all across the U.S. So that's really us. We don't have a lot of time here today, so I'm going to jump into the state and local tax issues that we have. If you have any questions along the way or comments that you want to make, please put those into the chat, and I will do my best to answer those as soon as I can, as soon as I see them. Um, so, chat or the Q&A. I always don't remember which one it is, but one of those functions should work. And if you drop a question in there, I'll be able to answer it. Okay, well, let's jump in. So SALT, as I mentioned, that stands for state and local taxes. State and local taxes issues are often overlooked in M&A transactions, but they can really significantly increase tax costs, and so they should be considered. And that's what we're trying to provide today, a little overview of how that might work. So, as I mentioned earlier, the state and local taxes can include both income taxes and non-income taxes. However, we're going to be focusing on the non-income taxes. Usually that comes in the form of sales and use tax. In addition to sales and use tax, though, some of the other non-income state and local tax issues could include, some states have a stock transfer tax, so that's something to look at even in a stock sale, and real estate transfer taxes. So if there's a real estate involved in the M&A deal, then there could be some transfer taxes related to the real estate. That very really depends on the state and sometimes even the location in the state, the county or where the real estate is located could also affect that. So, the form of the M&A transaction is, for tax purposes, really does impact the state and local tax issues. So generally, asset sales are subject to sales and use and other transfer taxes under state and local law, while stock sales generally do not result in sales, use or transfer taxes. And so it usually applies to the sale of tangible personal property. That's where sales and use tax comes up. And then so that's going to be your furniture, fixtures, and equipment, inventory, things like that. It doesn't usually cover it doesn't usually cover intangible property. So like stock or goodwill or IP, that usually doesn't apply to it. So, and as I mentioned before, most buyers and sellers are concerned about the federal income tax consequences of a deal. And so the state and local taxes are kind of something that comes up later, or sometimes is an issue that's not even thought of until later in the process. But I'm here to try to give you some advice on what that looks like, and so you can anticipate the potential state and local tax issues and address it early in the process so it doesn't become a surprise at the end of the day. And state and local taxes obviously vary by state and location in that state in some cases. And so we're located in Colorado. I'm going to mainly reference Colorado law just to have a state to base things off of. But obviously, anything I say here today would have to be double checked with whatever state you're in or wherever the property is located. And so that's where we would want to take a look at that. So, for example, in sales taxes can be a material concern in Colorado on asset transactions, because the tangible personal property is subject to state and local sales and use tax. And so this, for example, equipment used in manufacturing can be subject to a big sales tax. things like that. So we'll get into that here as we get into the rest of these slides. So for one, we have with stock versus asset deal. So I mentioned that earlier, but typically in a stock deal, you're not worried about the state and local taxes because you're just transferring the stock or the membership interest in an LLC, and so that's all intangible property, and there's no state and local tax issues, or typically there's not, unless there's one of those. It's in one of those states that has a stock transfer tax. So that's one big thing there that can change or big structure of the deal that can change what the state and local taxes may be. The other big thing to know about that is that about state and local taxes is that there's successor liability. So this is a big issue. So even in the asset sale, where state and local tax comes up, oftentimes there's rules in the IR or the regulatory department, whatever the Department of Revenue in the particular state. There's typically statutes that say that they can come after both the seller and the buyer in these situations. So, this is one of those things where you structure a deal as an asset sale, and your intent is to only take on certain assets and to exclude all liabilities. And you can do that. You can exclude all the liabilities by contract, and you can have indemnification provisions so that the buyer can go after the seller in the case that there is any liability for state and local taxes that were historical and then weren't paid by the seller. But it doesn't change the IRS or the state Department of Revenue's ability to come after you as the buyer. And so that's something to think about, that there is successor liability typically built into the statutes of the sales and use tax code of any state to be able to come after you. So if the buyer inherits unpaid tax liability, then this can apply in an asset deal. It can obviously apply in a stock deal as well. If you buy the equity of a company in a transaction, then you're gonna be the successor to all the liabilities of that entity. So if there's unpaid tax liability, then you would be subject to that as well. And so that's something to check out in due diligence. But you're going into that one with eyes wide open. In the asset deal, you got to remember that there still is successor liability potentially to come after you, even if you carve out those liabilities from the deal. So, just so in general, to sum that up, a stock deal, you assume all liability for unpaid taxes. In an asset deal, you may assume them there as well, even though you've carved them out of the transaction. One decision which is was a Supreme Court decision called Wayfair. This happened a while back. This was a 2018 case, and so state and local tax issues have really become more of an issue after this. This Wayfair decision changed the game because prior to this Wayfair decision, you had to have a physical presence in a state. You had what they called economic nexus. Just a physical nexus in a state for them to charge you state and local tax. And so this Wayfair decision was a Supreme Court case where Wayfair, as you may know, is a furniture company that sells furniture mostly online. And so they ship it to a certain location. And the way they would sell it, they would be located in one state, but they would sell it to people in other states. And they'd ship it there. And they said that they didn't have to collect sales tax because they didn't have a physical presence there. They were just, sending things there. And the Supreme Court came up with the economic nexus to say that if you sell things in a state, even if you don't have a physical presence in the state, then you can have an economic nexus, and those states can tax you. They can tax you even though you don't have a physical presence there. So you can be required as the seller to collect sales tax. Now, this is an issue for companies, whether it's a stock deal or an asset deal, if the company that you're buying or the business that you're buying has not paid it in all states. So, software companies that are selling software in other states, there's now a lot of states are charging tax on those. Or if they're selling physical products in other states, but they're not paying the sales tax or collecting the sales tax on it, then, those could be issues that you inherit moving forward. So it's definitely something to in due diligence that you need to check out. Um, and so, selling inventory in multiple states, this can definitely be an issue. And so something to think about as you're going through due diligence. How do you manage these risks? It's really these indemnification provisions. So one is to do due diligence, see where they're selling products and see if they're filing sales and use tax returns or if they're required to. There's accounting firms and other firms out there that will go and review their a company's sales and where they're selling, and then review the sales tax provisions of that state and give you a report on whether they should have been paying sales tax, and if they haven't, then what's the potential risk to you as the buyer. And so that's become a big piece of M&A due diligence these days. And so oftentimes, in the past, there's a lot, mainly buyers relied on the indemnification provisions. So they said, we're going to have indemnification. If you didn't pay your state and local tax, then we're going to be able to come after you for indemnification claims. That this has become such an issue since this Wayfair decision that most buyers are going a step further, and they're requiring either tax clearance certificates, voluntary disclosure agreements. So that's where they can force the seller to voluntarily disclose that they were selling in the state but failed to collect sales tax, and to try to enter into a negotiated settlement, basically, with that state to say, all right, we're going to go through this voluntary disclosure agreement, and you're going to give us a discount on what we have owed since we didn't pay it back when we were supposed to. And so sometimes that's a post-closing covenant in an M&A transaction. You also see oftentimes there's a holdback, a purchase price holdback. If due diligence reveals that there's a lot of potential state and local tax issues, then that could lead to a holdback in a purchase agreement, which is another way or an escrow. The money part of the purchase price could go into escrow, or could just be held back to satisfy any claims that are related to these failure to pay sales tax issues in the future. And so, so far we've kind of been talking about the inherited liability of a seller who has failed to pay sales tax. And so that's one piece of the puzzle. And then, not this slide, but the next slide, we're going to get into the other piece of the puzzle, which I'll get into. But just keep that in your mind, that this is really what we've been talking about so far is, has the seller collected sales tax when they were supposed to? And if not, what's the potential liability to the buyer? That they may either have as successor liability, or they may inherit if it's an equity deal. They're buying the stock or the membership interest of the company. Some of the other things to take a look at, obviously, in due diligence is to look for tax liens. State and local departments of revenue can put on tax liens on assets and things like that. And so you want to take a look and make sure and do a lien search. Colorado law provides for a variety of tax liens, some of which may accrue and constitute a senior lien without even notice to the owner or prospective purchaser. So that's, it's a big issue there. Under almost all revenue collection statutes in states and at the federal level, there's a lot of power that's given to these regulatory departments to be able to collect tax from almost anybody. And so, buyers and sellers. So there's just a lot of concern when you're doing an M&A deal to really diligence this, find out if get tax clearance certificates, look for tax liens, diligence the way that the company operates to see where they're selling products, if they do sell physical products, or even software in other states, to see if there's a potential tax liability that you might be inheriting. And if so, then you got to figure out how to protect yourself if you want to move forward with the deal with some of the options that I mentioned earlier, which is, indemnification, obviously, holdbacks or escrows, and covenants regarding voluntary disclosure agreements. So, all right, so that's one kind of half of the puzzle as we get about halfway through the presentation here. The other half is we're going to be talking about we're going to be talking about exemptions, and then we're talking about purchase price allocation. So we, if you have an asset deal, then you also have a, sale of you typically have sale of FF&E, and you have a sale of tangible personal property, which can be the sale itself. The M&A transaction itself can create sales and use tax. And so typically this is negotiated in the deal. Who's going to pay it and what is the purchase price allocation for it. Now, obviously, the purchase price allocation has to be reasonable, or else the IRS could come in and or even the state and local governments could come in and could recharacterize those prices if the purchase price allocation wasn't done correctly. But in general, whatever the parties agree to is going to be upheld, because it's an arm's length transaction, and that what's good for one side typically isn't good for the other. So in the way that the law typically works in most states is that it's the seller's duty to collect the sales and use tax unless it's exempt. So if you're selling, tangible personal property, that's your duty to collect it unless it's exempt. Inventory, so wholesale purchases are typically exempt from sales tax, because you're buying it and then selling it to a consumer later, which when you do that, you would be selling sales tax. So, if the company's a wholesaler, maybe they aren't collecting sales tax because they're selling it to somebody who's going to resell it. So you want to make sure that you're checking for a sale and resale certificate if that's the case. And what else do I want to say about this? Oh, exemptions. So some states have, and we're talking about just the sale of the assets themselves in an asset deal. The sale of the assets from the seller to the buyer in an M&A transaction. Is there an exemption there from the sale? Some states have what's called an occasional sale exemption. So this says that the sale of a one-time sale of tangible personal property is not going to be is not going to trigger any sales or use tax. And so that would be the situation of an M&A deal. In an M&A deal, say the company has a bunch of furniture, fixtures, and equipment that they have in an office, and that's part of the assets that are being sold to the buyer. Typically, sales of those type of things are subject to sales tax, but in this case, it was just an occasional sale. It was a sale from they're not in the business of selling those items. They're just selling the whole business, and so they're selling all the assets, and so that might fit into what's called an occasional sale exemption in some states. Colorado doesn't have an occasional sale exemption, so sometimes people call it a garage sale exemption as well. So it's meant to say, all right, if I'm selling, a bunch of clothes and other items or furniture in a garage sale, I don't have to technically collect sales tax. But because it's a one-time thing, I'm not in the business of selling those things. That exemption doesn't apply in Colorado, and so you have to look at these things, and you'd have to look on a state-by-state exemption or state-by-state to see what exemptions are there. Manufacturing equipment, there's also some exemptions in a lot of states. Colorado has them as well. If you're selling a manufacturing equipment, then that may be subject to an exemption. Depends on, there are very specific rules on that, so you would have to check into that. And then there may be other exemptions that certain states have. So that's something to think about as well, is what are the, are there any other exemptions in the type of assets that the seller company has? Okay, so how does purchase price allocation play into this? As you may know, in any asset deal or any deal that's taxed as an asset sale, so it could be technically a stock deal that's using election to be taxed as an asset deal for tax purposes. There's a Form 8594, and it requires that you, under 1060 of the code, that you follow this residual method. And the residual method basically gives you categories of where the assets fit in. So like cash. If there's cash being transferred, then that's treated as one class of asset. Then there's furnitures, fixtures, and equipment. There's general intangibles. There's goodwill. There's a couple others in that form that you would go down the list. And really, you put in all the assets starting from class one all the way down to, I believe, class seven, and then whatever's left over is that goodwill that fits into the last class. And so that's what you're buying. And that's how you allocate the purchase price. Um, and so the purchase price allocation can have a lot of effects from both federal income tax as well as state and local tax. The from a sell side, the sellers typically don't want to allocate a bunch of the purchase price to furnitures, fixtures, and equipment or tangible personal property because likely they have depreciated those down to very low basis, which means that any amount that's allocated above their basis is going to be treated typically as ordinary income because it's depreciation recapture. So that's the federal income tax side. But the state and local tax issue is also an issue because if you allocate more to that tangible personal property and there's no exemption that applies, then technically you're supposed to have sales tax, collect sales tax on that as well. So the sale of that furnitures, fixtures, and equipment in an asset deal is also going to be subject to state and local tax. And so again, that's something that can get negotiated in the purchase agreement on who pays that. So who pays that state and local tax? Is it going to be the buyer or is it going to be the seller? And so it's an important thing to do. One of the things that I look at is, if one person is going to be, it's the way that the purchase price allocation sometimes works is it's agreed upon in advance and at closing, so everybody knows what it is. Other times, the way the purchase price allocation works is that the buyer provides the allocation post closing, and so you want to be careful with that, depending on who's paying the sales tax. If you're getting to decide what the allocation is and the other side is paying the sales tax, then that can be an issue. From a buy side, you want to allocate a bunch of the purchase price to that furnitures, fixtures, and equipment because for one, you get to get that stepped up basis in those, which you get to depreciate over a short period of time, which gives you a tax benefit in the short term versus, if it all goes to goodwill, then that's something that you have to amortize over 15 years as a buyer. And so, you go through you can have a big issue here if the same person who's putting together the purchase price allocation or the person that's putting together the purchase price allocation is not paying any of the sales and use tax, then that can be an issue because it can create, a little bit of too much negotiation leverage there in my mind. And so I always try to take a look at that and say who's agreeing to pay it and who's putting together the purchase price allocation. And if we can't come up with a good result there, then typically I try to get the purchase price allocation agreed upon in advance or at closing. All right, let's see here. What else? Residual method we talked about. Yeah, different ways just checking my notes here. Yeah, I think that's the big issues with state and or the purchase price allocation that I think come up in an M&A transaction. Let's go to the next slide. So yeah, and so I'm just going to give you a little bit about Colorado here because I think that's going to be helpful to kind of see. So in Colorado, the way it works is the state imposes and they collect a 2.91% tax, and they also, the state also will collect on behalf of special districts, and so that part is all done as from the state. There's different home rule cities and things like that which can add complexity to it, but really it applies in all taxable sales. So any sale or exchange of property or services is for consideration is a taxable sale, and so retail sales or taxable sales, but also sales, like as I mentioned, in an M&A transaction, sales of personal property are also subject to this. And so that is really the big issue. There has been some, I'll throw this out there because I feel like I get this question at least once a year. about somebody coming up with an idea, which I have down last bullet point on what's called a drop kick transaction, or at least I've called it that and heard others call it that. And that's where they say, well, hey, couldn't we avoid this by just having the seller create a new LLC, drop all the assets, contribute all the assets into that LLC, so it's a brand new entity, so we're not really worried about you know, historical liabilities, and then sell us the membership interest in that LLC, which aren't subject to sales and use tax. Because now we have, we're selling membership interest in an LLC, and we're not selling the assets themselves. And so, does that work? And most states have seen this and have looked at this. And so there was a case back in 2006 in Colorado, and I'm sure there's cases like this in almost every state. And they agreed to, the seller and the buyer agreed to an asset purchase initially, and then seller transferred all the assets into an LLC, and which is a tax-free event. You can transfer your assets into LLC in exchange for the membership interest, and that's not taxable. And then the seller sold the LLC interest to the buyer. Denver audited the seller and assessed sales tax on the transfer of all the tangible personal property to the LLC. And this went up to the Court of Appeals, and the Court of Appeals upheld the assessment. And the court held that the entire transfer was essentially a single transaction. So they received the consideration in the form of membership interest for transferring the box, all the assets to that LLC, and then the membership interests were sold right after that for $16.5 million. And so there was a transfer. They basically took that transaction and said, we're going to take away this extra step that you took to avoid tax liability and come after you for that. That the only reason you set this LLC up was to avoid tax liability. And so anyway, I am not aware of a case in a state where they've said that this works. So, something to think about, that it's probably not a viable option in most states, but like I said, I get this question probably once a year and have to talk through it and see, does that work? And most of the time it actually doesn't. So anyway, if it was to be challenged on audit, then you would likely have that be a step transaction, and they would still be able to come after you. So, yeah, that is a whirlwind tour of the state and local tax issues that show up in M&A. I'm happy to answer any questions. My email is here. I know this is a quick one, but hopefully, it's kind of a niche topic, and wanted to get it out there with, our thoughts on it. And if you have questions, send me an email. I don't see any questions in the chat right now. But so I guess that'll be it for the day. If you have, like I said, if you do have any questions, call us. If you have a transaction that's coming up, then give us a call. We'd love to help you out with it. And talk with you about it and see if we're the best fit to help you. Feel free to reach out, email, give us a call, whatever works easiest for you. Appreciate you guys taking the time to stick around and learn about state and local tax issues. Have a good one.